Very good evening to you, all of you students. So today we are going to resume our topic on the dividends. Good evening, Hitesh. Good evening, Annie. Good evening, Siddharth, Karthik, Banredi, Siddhant, and Mancha. Yeah. So we'll take some of the queries that were pending from the last session, right, during the course. And first of all, let us start with some couple of new formulas, which might not be new for all of you, but still, because the future questions are based on that, so I thought of better putting it up here. So there is a term called PE ratio, price earnings ratio. This is a very simple formula to understand. What is this? This is market price divided by earnings per share. Market price per share divided by earnings per share. So this will give you, let's say, 17 times. I'm just assuming, let's say the result of P ratio comes as 17. So it means what? It means your share is trading in the market 17 times of what you earn. You earn 1 rupee per share. That means your share worth is 17 rupees in the market. So higher the P ratio, better it is. Similarly, if we want to derive the cost of equity from the PE ratio, so can we say that cost of equity generally is EPS divided by MPS, right? Because EPS is the total amount that you are earning for a particular year divided by the market price, or we can say that 1 by PE ratio is equal to the cost of equity. So remember this relationship, that cost of equity is inverse of PE ratio. This is very important. This is very, very important and useful in some of the questions. Now, Mansha had asked during last class, I had asked about the startup valuation, how they assess risk. May have been SEBI listening now, SEBI valuation of startup from PE and VC firms. Okay, Mansha. So that is a very, diplomatic thing to answer. See, because now if you ask, I mean, my personal viewpoint on the startup valuation, right? So if you see valuation as a concept, it has been defined in different legislations and regulations. For example, you have a valuation prescribed under FEMA rules, Foreign Exchange Management Act. Similarly, you have a valuation prescribed under income tax, correct? Because while you are selling certain assets under income tax, those has to be valued before you arrive at any income on that. Now, if you ask on the startup specifically, so the valuation here is from the perspective of a commercial transaction, correct? So this is between the venture capitalist and the startup, or let's say the founder of that startup. So that is for a commercial negotiation between both of them. So it can take as whatever forms and means between them in terms of the negotiation, whatever they want. Now, for example, if I am going for a negotiation, right, I would say that, okay, discounted cash flow is the right method for the valuation. But somebody else might think, no, discounted cash flow is one way, but we will give 50% weightage to DCF method and another 50% we will go for a NAV kind of a method. Correct. So there is no, on the startups as of now, if you ask on the commercial negotiation part or the commercial transaction part, so the valuation can take form, which is the mutual consent between both the parties, right? However, while you value your IPO, so see, when SEBI will come into the picture, when any startup wants to go to public for raising the funds, whenever they want to go for an IPO listing, at that point of time, whatever valuation they give for their shares, that would be definitely scrutinized. Okay, that is where the control point is. Now, although in the past we have also seen there are some issues related around it, but that's how the industry is. Then Jinesha, good evening. Raghavan, good evening. I hope Mansha, your doubt is clear. Okay, something off the track, something that we deviated, but yes, since you asked, I answered my viewpoint. Okay, now please remember this relationship. Okay, now I'm coming back to the questions where we left. So question number 11, it says that earnings of the company is 5 lakhs. So the following information pertains to Messrs XY Limited. The earnings are given as 5 lakhs. dividend payout ratio is 60%. So whatever they earn out of that 60%, they give as dividend. Number of shares outstanding is 1 lakh. Equity capitalization rate is 12% and rate of return is 15%. So cost of equity is 12% and rate of return, which is R, is 15%. Calculate market value per share as per Walter's model. Very easy, very simple. It just, numbers putting exercise in formula. That's all. First of all, can we write that as per Walter's model? Okay, the market value they are asking. So the market value is given as price is equal to dividend plus earnings minus dividend. The balance portion, the retention, on that we will earn R divided by KE, whole divided by KE for doing their present valuation. Okay. So here we have everything. So if we see, first of all, 5 lakhs is what we are earning and 60% is the dividend. So we can say that dividend is equal to 5 lakhs multiplied by 60% divided by 1 lakh. So which is 3 per share. Similarly, earnings is equal to 5 lakh divided by 1 lakh, which is equal to 5 per share. Correct? And then R is given as 15%. Those numbers are already given in the question. So now we are just putting the numbers in that equation, okay? Which is given as 3 plus 15% divided by 12%, 5 minus 3, which is 2 rupees that they are going to retain. And for doing the present valuation, we are just dividing it by this. So 45.83 is the price. So price is equal to 45.83 per share. This is the first part where they are asking about the market price as per the Walter's model. Okay, Hiral, I will explain that. Hiral is asking about the difference between CE method and risk-adjusted discount rate method. I will explain that. Karthik is asking, sir, in the formula P1 is equal to P0 1 KE minus D1, why not P1 is equal to P0? As P0 KE part is the cost of capital and there is assumption of no flotation cost. So KE should consist of expectation of shareholders only, that is dividend. So, okay, I'll explain that, Karthik, again. Hitesh, you are right. Your answer is correct. Okay. Now, I'll take the queries in order. I'll hold here for a moment. Now, from the previous session, there was a query from Mancha, which said on the IRR. Okay. So first of all, students, I want all of you to please note very, very, very carefully. There is this one, correction I would like to highlight. Just a second. Let me go to the Walter's model. Yeah, here. So what I mentioned here. So please remove this IRR from here. First of all. Okay. So first of all, remove IRR. As a principle, always compare cost of equity with the rate of return. That's all. Rate of return is actually what you earn on your investment, and cost of capital is the expectation from the shareholder. We just now saw mathematically what is KE. Let me come here. We just now saw mathematically KE is equal to EPS divided by MPS, and R is also equal to EPS divided by book value per share. Simple. This is your rate of return. This is actually what you are getting. Correct. So KE is this and R is this. Simple. These two numbers has to be compared for a dividend payout. Now then there was a question that in the study material on page number 9.7 for the last sixth point, it was mentioned. Point number 6. Let me open the study material. Just a second. .7. Let me go to the page number 9.7. Yeah. 9.7, point number 6 on page 9.7. Okay. It mentioned what? It mentioned that if IRR is greater than cost of equity, then dividend payout should be higher. Okay, this is what is mentioned. So it is mentioned, exact language is, if the internal rate of return is more than the cost of retained earnings, it is better to distribute the earnings as much as possible. Now I'll tell you in which context this IRR is used. So first of all, students, what is IRR? You all know in your capital budgeting sessions that IRR is one benchmark rate, correct? Wait, let me insert a sheet here. See, IRR is your benchmark rate, is benchmark rate. If you feel that your project is giving above IRR, then you will accept the proposal. If it is giving you lesser than IRR, then you will reject the proposal, right? That is what the concept of IRR is. Now, so IRR will say that minimum this much we will need, correct? Now, the issue here is that we always compare IRR with so IRR is nothing but your required rate of return, correct? So that means if your required rate of return is higher than your expectations, then don't you feel that you will not invest into those opportunities and you will prefer to give more dividend? Okay. So if your required rate is higher than expected rate, then you will go for a payout only. So please, students, have this limited understanding only on account of this, because see, practically, as I told you, we always compare R with KE. R greater than KE, R less than KE, R is equal to KE. These are the three cases. And our entire Walter's model, Gordon's model theory is based on this. But this IRR thing is mentioned only in this context, and please understand this concept only in this context, which I just told you. Okay. I hope this IRR confusion is clear. Okay. Then the next thing from Karthik on this formula. So P1 is equal to P0, 1 plus cost of equity minus D1. Now here, if you see, okay, now if you see here, P1 is equal to P0, 1 plus KE minus D1. Now, if you see here, what we are doing, we are taking the today's price and that we are increasing with the cost of equity as a percentage. We are just multiplying this as a factor and trying to achieve that what should be my future price. So if you ignore D1 for a moment, it is nothing but your future value and present value, correct? This is your future value and this is your present value. Simple. And you're multiplying a cost of equity as a percentage on interest, which helps you moving from your present value to your future value. But now, if you go by that principle, okay, if you go by that principle, then it is fine. However, you have to take one more factor into consideration, which is, see, your price, whatever you get, is including the dividend if the company decides to pay it. If there is a dividend payment, then definitely your price will fall. Basis what I told you, right? There is one thing called as cum dividend price, and suddenly this is the X dividend price. So cum dividend, if you ignore this D1, then you will arrive at this cum dividend price. But if you consider that dividend and reduce that, then you will come at your X dividend price. Correct? So that is the reason, Karthik, we reduce D1 from there. Okay, now KE, as I told you, KE is the formula of KE is they take not only dividend, but they take the entire earnings on their particular share. That is what they expect. Correct. So even they expect whatever you pay them as dividend and whatever you retain, that total amount divided by M pays, that is what their expectation is. Okay. So again, now there is a contradiction which Karthik has also, pointed out in the study material. But again, I would say that, you please understand it from the contextual point of view where it is said. Again, I'm telling you that, always compare your cost of equity with the rate of return. That's the only point I would like to say. Okay. Mancha is asking, Walter and Gordon both are relevant theories, but Walter doesn't consider growth factor here. D1 or D0 are same, but Gordon considers growth. Here we D1, EPS1 comes to the picture. That's right. Mancha, you're right. That is correct. See, that's where if you see the Walter's model, okay, the formula it is this. It only takes that what is the current dividend and what is the earnings. On that, what is the retention ratio? On that, how much I will earn, and basis that what is my price. That's the only simple point. The growth factor is definitely considered by Gordon. Okay. Now, here I will take your question while we will do the revision of our risk analysis and capital budgeting. Okay. So only one query is left with me, which is the Hiral's query on CE method and risk adjusted discount rate method. Now, in this question, the second part is also asked optimum dividend payout ratio according to the Walters model and the market value of the company share at that payout ratio. Very easy and very simple. Now we will say that since R is greater than KE, hence it is better for the company to reinvest the entire amount, correct? And hence dividend payout should be 0. Okay. Now in that case, what is our revised price that we have to calculate? Okay. So we will put the revised numbers here. Price is equal to now dividend is 0. 15% by 12%, this remains same. 5 minus 0, entire divided by 12%. Correct? So this comes as 52.08. So the price is higher compared to the previous price. Correct? The price is higher. That means this is the optimum dividend payout ratio. Okay, Hiral, I will take that part as well. Page number 8.25, illustration 10. Okay. Very good, Hitesh. Your answer is correct. Now let us go to the next question. The next question is, taking an example of 3 different firms, that is growth, normal, and declining, calculate the share price using the Gordon's model. So it's very simple. Now, first of all, we can write or we can, recall what was our Gordon's model. E1, 1 minus B divided by KE minus BR. This was the simple model. We are not talking about the bird in hand theory. We are talking about the normal formula, right? Now, for growth firm, we will just put the numbers here. P0 is equal to E1. Now, earnings per share is given as 10 rupees, correct? And 1 minus B is your dividend payout ratio, which is 0.40. Or you can say 1 minus B is this, 1 minus 0.6. So I'm saying 1 minus 0.6, correct? This is 1 minus B. And this whole divided by 0.10, which is the cost of equity, cost of capital minus BR. B is 0.60 and R is what? R you will get 0.15. So this comes as 4 divided by 10% minus 9%, which is equal to 400 rupees. So this is the share price of a growing firm. Now similarly, normal firm. Normal firm also we are going to calculate it in the similar way. This is 10 is the earnings per share, 0.6, 0.4, this remains same. So 1 minus 0.6. Then what is the cost of equity? 10%. 10% minus, again 10% into 60%. Correct? Because their rate of return is also 10%. That is why it is a normal firm. So the overall amount comes as rupees 100 per share. Similarly, third type. Third type is the declining firm. Declining firm where it will be where the expectation is higher than the actual rate of return. So P0 is equal to 10, 1 minus 0.6 divided by 10% minus 8% is their return and 60% is the retention. So it comes as 76.92 rupees. Simple. Okay. So I think that's all. That is what the question had asked us to do. Sneha, good evening. Hitesh, your answers are correct. 400 and 100. Perfect. So Mancha is asking that in all examples we are dealing with now and 1 year from now, which is T0 and T1. Is it possible for us that question asks us value of 3 years? Yes, it can be possible. However, wherever they will ask us to apply Walter's model and Gordon's model, then since both these are dealing with P0, D and E and retention ratio R and KE, so only these, so the question will revolve around these things only. Okay. However, if they ask about the dividend discounting model, where they can give us, future discount project, future dividend projections for let's say next 10 years also. So in that case, question will involve 10 years value and 10 years present value. Okay. So now next question. Next question is question number 13. The following is the information given below in case of Aditya Limited. Earnings per share 60, capitalization rate, return on investment, dividend payout. Calculate the share price using Walter's model. So first of all, using Walter's model. So P is equal to D plus E minus D, R divided by KE, whole divided by KE. Correct? Now here, earnings per share is 60 and dividend payout ratio is 30%. So this is the D plus 60 minus 30% on 60. This is E minus D. R will be 25% divided by capitalization rate of 15%, whole divided by 15%. So this comes as price is equal to 586.67 per share. So this is the first part of the question. What would be the optimum dividend payout ratio per share under Gordon's model? See, both Walter and Gordon have suggested the same principle for determining the optimum payout ratio. Here R is greater than KE. So optimum payout ratio is no dividend. Simple. So we can say that it would be 0 simply since R is greater than KE. Okay. I hope this is clear. Please don't forget to put it in a proper, representation manner. I've just put it the second point answer here only, but it should be properly explained that since return on investment of 25% is greater than the capitalization rate of 15%, hence it is better for the company, for Aditya Limited, to reinvest the entire amount of earnings into the business rather than paying any dividend as per the Gordon's model. Simple. Perfect, Hitesh. That is right. Mancha, you're right. Now let's come to question number 14. Now question number 14 is, what does it say? The dividend payout ratio of H Limited is 40%. The company follows traditional approach to dividend policy with a multiplier of 9 compute PE ratio. Now students, please note here, P ratio was what? PE ratio was MPS divided by EPS. Can we say that P divided by E? Simple, price divided by earnings. Now traditional approach is Graham and Dodd model, which said that P is equal to M D plus E by 3. Simple. That is simply as per the formula. This is the traditional approach. Now instead of P, so P is equal to M is given as 9. Dividend is 40% of the earnings. So can we say that instead of dividend, can we say that 0.4 times of E divided by 3? Simple. So instead of dividend, so since dividend is equal to 40% of earnings, so hence we are saying that D is equal to 0.4 E. So that we have substituted here. Now if you solve this, then P is equal to, if you open the brackets and do the multiplication and then division, it comes as 6.6 E. Correct. So the P by E is equal to 6.6. That is the price earnings ratio. So the P multiple is 6.6 times. I hope the question is clear along with the solution. Right, students? If you have any doubt, please do ask. Very easy and very simple question. Let's go to question number 15. So question number 15, it says that M Limited belongs to a risk class for which the capitalization rate, which is KE, is 10%. It has 25,000 shares and the current market price is 100. It expects a net profit of 2,50,000 for the period. So for the period to come, it expects 2,50,000 as profit, and board is considering a dividend of rupees 5 per share. So see, now students, they are sitting as on today and they're evaluating something for the future. They say that, okay, we will have a profit of 2,50,000 and maybe we can pay 5 rupees per share as dividend. And they also say that they need to raise 5 lakh for an approved investment expenditure. Illustrate how the MM approach affects the value of M Limited if dividends are paid or not paid. So they are saying that, see, what does the MM approach said? MM approach said simple things. If you pay dividend or if you don't pay dividend, your market value, your value of the firm will remain same. There is no change in that. So let's see what are the things that are given to us. Cost of equity is given as 10%. Shares are given as how much? 25,000 numbers, right? Then current market price is how much? P0 is actually 100 rupees. Okay. They are also saying that net profit they are going to get is 2,50,000. And in case they are going to pay the dividend, the expected dividend will be how much? 5 per share. And lastly, expected investment. So the investment expected is how much? 5 lakh rupees. So these are the things that are given to you. Now let us say that case A. So what have they said? Are paid. So let's take the paid case first. So dividends are paid. If dividends are paid, then your P1 will be, what is your P0? 100 rupees. Cost of equity 10% minus D1, which is 5 rupees. Okay. I'm using this formula. P1 is equal to P0, 1 plus KE minus D1. Just now that we have explained this formula, right? So the price here comes as 105. Now, B step, funds requirement. Now we have to estimate the funds requirement. So we will start with what is our investment plan. Investment plan is 5 lakh rupees. Out of this investment, there is a earnings that will come to us, 2,50,000 rupees. Plus there is a dividend payout that has to happen after 1 year. That is how much? 5 into 25,000 shares. So this is 1,25,000. The total comes as 3,75,000. Net funds required. C part, number of equity shares to be issued. Because in approach, we always knew that whatever is your net funds requirement, that has to be covered up by the new issue of equity shares to be issued. This is 3,75,000 whole divided by whatever is the price per share at that point of time is 105. So this comes as 3571.4258. Or we can leave this here as well, so that when we apply our formula, it will help. But we can put it any which ways, whatever we want. 3571.4285 shares. Okay. Then last part, value of the firm. This is how much? N plus delta N. I am writing the formula P1 minus earnings plus investment whole divided by 1 plus KE. That was the formula, right? Sorry, it was plus earnings minus investment. So this comes as 25,000 are the existing shares. The new shares, I am using the same number because it will help in the calculation, right? Multiplied by 105 minus 5 lakh plus 2,50,000 whole divided by 1 plus 10%. So this gives the value of firm as 25 lakh rupees. Perfect. So Hitesh, your answer in the previous question was right, 6.6 times. Mansha is saying in theory, value of the firm at T0 and T1 should be same. Your answer is right, Mansha, but yes, there will be difference of 3 things. One is the future value and present value. And second one is your incremental earnings and incremental investments. Okay. So we can't say that T1 will be equal to T0. We can say that T0 in case dividends are paid and T0 in case dividends are not paid will be same. And T1 in case dividends are paid and T1 in case dividends are not paid, those will be same. Okay. So, but we can't say that T1 will be equal to T0. That we can't say. Okay, Mancha? Hiral, please show last sum again. Okay. I'm just going to the last sum again, which is the 14th question. Then Manja is saying, sorry, Hiral, okay, last sum I have shown. Hitesh is asking when dividend paid. Okay, perfect. Dividend is not paid. Yes, right. Hitesh, your answer is correct. When dividend are paid, yes, Mancha, your answer is also correct. Perfect. And value of the firm is also right. When dividends are not paid, okay, Mancha, perfect. Then Hitesh, investment plan, yes, perfect. Hitesh, your answer are correct. Almost all the answers are very correct. Okay, Hiral, I'll explain the last sum again. Okay, Mancha and Hitesh, your answers are correct. Now Hiral, and Hiral and everyone, I am explaining question number 14 again. So the dividend payout ratio of H Limited is 40%. That means we can say that dividend is equal to 40% of your earnings. And hence, can we substitute D is equal to 0.4E? Now, the question also says that they follow a traditional approach. Traditional approach formula is given by Grams and Dad model, which is P is equal to multiplier D plus E by 3. Now, since we know that price earnings ratio is P by E, in this entire formula, we never know what is P and we never know what is E, but we know that what is the relationship between both of them, we will be able to arrive at PE ratio. Hence, we just substituted whatever multiplier is given and we made D in the form of E again. So once you solve this and multiply with this, you will get P is equal to 6.6 E. Now we, through this traditional approach, we came to know, okay, the P by E is equal to 6.6, which is as good as your price earnings ratio. Okay. So in this question, I understand that in one equation, there were two variables that were missing and we were asked something else, but we knew that there is a relationship between P and E. We use that relationship to solve the PE ratio. Okay, Hiral, I hope this part is clear to you. Now, coming to question number 15 back, and now we will take the case 2 where dividends are not paid. Okay, where dividends are not paid. Now, in case dividends are not paid, we will repeat all those steps again. So first of all, P1 will be 100 rupees, 1 plus 10% minus 0. So P1 comes as 110. This is step number 1. Step number 2, investments required. Investments required, I'm just putting in a rough manner here. Okay. 5 lakh minus 2 lakh 50,000 is our earnings. So net funds requirement is 2 lakh 50,000. Third step, number of equity shares, 2 lakh 50,000 divided by 110. We will keep it like this. Now value of the firm, which is 25,000 shares plus 2 lakh 50,000 divided by 110 multiplied by 110. Okay, then minus investments, which is 5 lakh rupees plus earnings, which is 2 lakh 50,000 rupees, whole divided by 1 plus 10%. This also, if you solve, it will give you 25 lakh rupees again. So hence proved, and please note student, this is the value of the firm as on today, right? Not as on 1 year, after the end of 1 year. This is as on today. In both the cases, it is coming as 25 lakh rupees only. So Hitesh is saying when dividend are not paid, step 2, perfect, 2 lakh 50,000 is the net requirement. Step 3 and step 4 are also right, Hitesh. Perfect. Very good, students. This is the question. I think this was a very simple question that has revised our approach, correct? Then question number 16th. The following information is supplied to you. Total earnings is 2 lakhs. Number of equity shares is 20,000. Dividend paid is 1 lakh 50 and P ratio is 12.5%. Sorry, 12.5. Dividend paid is 1 lakh 50,000 out of the earnings of 2 lakh. So they are saying apply Walter's model, analyze whether the company is following an optimal dividend policy or not. So students, if you see, for applying Walter's model, first of all, for us to conclude whether it is an optimal dividend policy or not, we need values of R and KE. Correct? We need values of R and KE. Now, as I told you in my previous, just when we started this session, R is given as EPS divided by book value per share, and KE is given as EPS divided by MPS. In case it is not there, we can just take 1 by PE ratio. Correct, students? This is what I just told you. So in this case, for calculating R, we know that EPS is what? EPS will be 2 lakhs divided by 20,000. So EPS is 100. Sorry, EPS will be 10. Correct? EPS is 10 and hence R is equal to 10 by 100, which is equal to 10%. This is your R. which is the actual rate of return. And for calculating KE is equal to 1 by 12 and a half. So 1 by 12 and a half comes as 8 percentage. If you solve this, this will come as 8 percentage. Any questions till now? So Pooja is asking, do we get theory questions in FM? Maybe yes, maybe no. Okay, so we have to prepare for everything. So that is the thing, Pooja, I can answer. Maybe you can just check with the main faculty on this aspect as well. Okay. Hiral is asking, clearly KR is less than KE. KR is less than his KE, then only the dividend, but not K is mentioned. Is it correct? Okay, 9.7 you are saying. Page number 9.7. Okay, wait, let me see Hiral. No, 9.7 just now we explained. I'll just open if you have the same query. 9.7. Just a second. I'm opening in the study material. Hiral, which part are you asking? 9.7. Can you just please refer which is the part that you are asking? So Hiral, please mention that on 9.7, where have you read this? KR is where have you read? Okay. Mancha, P is equal to K is equal to rate of returnings. P by E, no. P by E is not equal to KE. 1 by PE is equal to KE, Mancha. Okay. Hitesh, K is equal to 8. Hitesh, dividend by share 7.5. Okay, dividend per share is 7.5. That's correct. 150 by 20,000. So this is fine. Now here we have a Hiral is saying last para IRR. Correct. So Hiral, that's what I just now explained in the beginning again. And Prabhas is also saying on the last of the page. So just now I explained it. I'll just go back again and tell all. See, we have to understand it again from the contextual point of view. Please don't take that as, the correct yardstick, because the correct yardstick, as I told you, is R and KE. R is the actual rate of return and KE is your expected rate of return. Wait, let me go to the start of today's session. I think we started with question number 11. This one. Yeah. So, but just to understand why it is mentioned and just to, satisfy what is mentioned there. See, IRR is a benchmark rate, correct? Because IRR is something that you should earn to make your NPV positive, correct? So required rate, so can I say that IRR is the minimum required rate? Yes. If your required rate is more than your expected rate, then you don't feel that you should not invest in there, correct? However, since this comparison is wrong, I totally agree with all of you what you are asking, because this comparison nowhere draws out between what is the actual rate of return and what is your expected rate of return, which I am again and again telling that that is the right thing to compare, correct? But since this is given, hence I'm trying to explain that if your required rate is greater than your expected rate, then definitely you will not put money into that venture. You will try to get more and more money out of the dividend. However, Karthik also noted one contradiction that is given against this concept on 9.9 point number A, correct? Which also again I am not denying the fact. So hence, please understand that, for all practical reasons, for from the understanding point of view, this is the right approach to compare. Please don't get into this trap of IRR at all. Okay. Because IRR is, again I'm saying, is just a benchmark rate to compare it. That's all. Okay, guys, and let's not waste our time again on this. Okay, now coming back to our question number 15, 16, this we have done. Yeah, so we were on this question number 16. Analyze whether company is following an optimal dividend policy. Okay, sure. So see, now they are asking that what is the optimal dividend policy. Now, if your R is 10% and KE is equal to 8%, okay. If your R is 10% and cost of equity is 8%, then what is your optimum dividend policy? Your optimum dividend policy says that, see, now here we are comparing, right, students, again, right? Because we are comparing actual return with the expected return. That is the right way to compare. Now, if I go back, so the dividend payout should be what? Dividend payout should be 0, correct? Because your actual return is higher, so you will tend to invest more in your business. Okay. Now, they are also saying that whether the company is following a optimal dividend policy, we feel that they are not following a optimal dividend policy because it they are currently having a payout ratio of 75%, correct? So can we calculate calculation of share price at 75% payout and 0% payout, because 0% payout is what we feel it should be, correct? So before this, we can say that optimal dividend policy would be to reinvest and 0% payout. Okay. Since R is greater than K, again, you can complete that line because that's a standard thing that we should follow. Now, if we follow a 75% payout, then your price will be 7.5 because your dividend per share is how much? DPS, dividend per share, will be 1,50,000 divided by 20,000. So this comes as 7.5 per share. Okay. So we are applying the Walters model here. Okay. So dividend plus earnings minus dividend. Earnings were how much? 10 minus 7.5 multiplied by 10% is the rate of return and 8% was cost of equity, whole divided by 8%. And in case of 0% payout, 0, 10 multiplied by 10% divided by 8%, whole divided by 8%. Okay. Perfect. So this gives us the answer of 132.81 and this gives us the answer of 156.25. Okay, students. So we can say that since we are not following an optimal policy, the price is lesser compared to the optimal policy price. Okay. Now, next part is very interesting here. Yes, Hiral is saying finally focus on R and KE only. That's yes. Please focus on R and KE only. Karthik, reinvest is optimum, dividend is 0. Perfect. Mansha, 132.81. You're right. Hitesh, your answers are correct. Perfect. Okay. Yes. So this is the part of first question. Then second is compute the PE ratio at which the dividend policy will have no effect on the value of the share. So they are saying that compute any PE ratio which will have no impact. So whatever dividend we pay out, it will have no impact. So students, we know that in which type of situation the dividend payout or no payout have an impact. When R is equal to KE, then any ratio of dividend payment then any ratio of dividend payment is an optimum ratio, correct? What is R is equal to K is equal to 10% here, correct? If R is equal to K is equal to 10, very good, Hitesh. Hitesh is given the right answer. If R is equal to K is to 10, then PE ratio is 1 by KE. If K is 1 by PE, then P is 1 by KE, right? So which is 1 by 10%. So this comes as 10 times. Because what you will do is 1 divided by 10 into 100. So this is coming as 10 times. So the P ratio is equal to 10 times. Simple. So if your P ratio is 10 times, then any dividend payout will have no impact. Okay, students, I hope this is clear. Then the last part, will your decision change if the P ratio is 8 instead of 12 and a half? So it is very simple. Again, we will compute everything again. Now, if P ratio is 8, then cost of equity will be 1 by 8, which is 12.5 percentage. Now, in such a case, your KE is greater than R because it is 12.5 percentage. This is 10 percentage. If that is the case, then optimum dividend should be 100%. Optimum dividend payout should be 100%. If that is the case, then it should be, we will take the 75% ratio only, which is given in the question. So R is 10%, 10 minus 7.5 whole divided by, what is the KE? 12.5 percentage whole divided by 12.5 percentage. So it comes as 76. So the revised price as per Walter's model come as price is equal to 76 rupees in case the P ratio changes. Okay. So that is what they were asking us to calculate. I'm just displaying this for a moment and then we will go to the next question. Mancha is saying R is equal to KE is equal to indifferent situation is equal to strategic decision should be taken. Very nice, Mancha. Very good. I actually really like that thought. Now you go with your strategic decision, because as per the financial decision, whether you pay or whether you don't pay, it doesn't make any difference. So whatever is right to you strategically, you should follow that. Very good. Hitesh, 76. That is right. Okay, now let us jump to the next question. So the next question is question number 17 for us. Okay, now this is a simple one. With the help of the following figures, calculate the market price per share of the company by using Walter's formula and dividend growth formula, which is the Gordon's formula, in which we have to make use of dividend and growth. The bird in hand theory formula. Okay. So the Walter's model, it says that P is equal to D plus E minus D, R divided by KE, whole divided by KE. Now let us put the numbers here. D is what? Dividend is 6 plus earnings is 10 minus 6 multiplied by rate of return is 25% divided by KE of 20% whole divided by 20%. So it comes as 55 rupees per share. Now let us go to the Gordon's formula, which is the dividend growth model. So it was given as E1, 1 minus B, K minus BR. Okay, even if you follow the other formula also, it will be same. Okay, whichever formula you follow that dividend formula D0, 1 plus growth, K minus G. This was the another formula, right? Even that formula will also be correct if you use that. The same answer will come. Okay. So it is 10, 1 minus 0.40 divided by 0.20 minus 0.40 multiplied by 0.25. Okay, so this comes as 60 rupees per share. Yes, Pooja, very good. Now see the kind of, thoughts that are coming. So Hitesh, your answer is correct. 55 and 60, that is right. Mancha, here EPS 1 should be taken. Why? EPS 1 should not be taken, no? EPS is already given as 10 rupees per share. So Pooja is saying practically it is possible that it won't make any difference, sir. And yes, I agree to you, Pooja. Practically it is not possible because it will make a difference and it will have a lot of other differences also. But as per that theory, it won't make a difference. Simple. Correct. So, because that theory said that investor will be indifferent if, because see how a rational investor thinks. Now, if to understand it, there are different kinds of investors. There will be investors like as educated as us we are. They will be as informed as we are. They can do these complex calculations as we are doing. So we will go simply by logic. Simply we will ignore our intent. We will ignore our intuition whether in future it is going to increase or decrease. On the other hand, there will be another set of investors who will believe on their intuition rather than something else. So there are different kinds of people and hence lot of factors in the market. But if this theory is followed, so this theory said simple things. These are your the points that you have to see, and this is how I will be guiding you. Okay. Now this question is also done. Perfect. Now, before we move on, students, there is actually a very general query with, which I have seen, which lot of students have, which is not specific to anyone and which is a very general thing, which even I also faced while I was studying. While you study, you keep on thinking that, okay, these concepts are clear to me. Now, again, when you revise those concepts, then you feel sometimes that, I have to again start from the scratch. I'm not able to retain. Or then, second bigger problem is that there is no confidence building, right? Because ultimately you should be confident while you enter into the examination hall. You should not be overconfident. You should be confident enough. And there should be some sort of a nervousness as well. Because if you're nervous, then definitely you will be feeling not overconfident. Okay. Now, there are some steps towards it. If you can work like in that direction, you will feel better about studying. One is that please understand well the concepts and practice as many questions as you can, different types. Now if you do the revision, right, so the next revision should be 100% of the entire subject and the entire curriculum that you have studied first, because that will help you to retain some things for the next revision. Now the third revision, the third time when you do, so while you were already doing the second time, so you mark important questions. Don't go for all the questions in the third revision. Mark important questions and those concepts where you feel that you need to devote more time. A, because those are more important from the examination perspective. B, those concepts where you feel that you are not able to get a very good understanding. You need to devote more time because it is specific to you, not specific to examination. Once you do that, then in the third in the third revision, you will feel that, okay, I will revise the concepts and I will only attempt those questions which I've marked as important in my second revision. Then in the third revision, again filter those questions, because ultimately in your examination time, you have to revise everything in that limited time, right? Of 1.5 day effectively, or let's say 1 day that you get. So please do make understand, and don't lose hope at any point of time, because whatever you are doing, the smallest thing that you are doing, somewhere or the other, it will help you in your examination hall. I am telling you that because I have experienced it. Okay. So please don't lose hope. Feel, and the confidence will come to you once you do these 2 or 3 revisions. I'm not saying do 100% revision, but at least the first revision should be 100% revision. You should devote good amount of time, whatever you have, because see, currently you are understanding, you're not retaining, you're just understanding to understand. The second time when you will do the, revision, at that point of time, your objective should be to retain. And third time, your objective should be to only you only see those things which are very important and which you are not able to retain. And then ultimately the fourth revision should happen where you should feel some sort of a confidence in you. Okay, so please don't lose hope. Again, I'm saying please do keep revising, because if you keep revising, there is a psychological theory as well. Higher you revise, higher you retain. Okay, even the concepts, again I'm saying. Okay, so question number 18. The annual report of XYZ Limited provides the following information for the financial year 2021. Net profit is 50 lakhs, outstanding 15% preference share is 100 lakhs, number of equity shares they have given, and R and K they have given. Gordon's model, they're asking us to calculate these three things. I think this is a very simple question. We can skip this. Okay. Thanks, Pooja. Thanks, Neha. So these are very simple, questions using the Gordon's model. I'm just simply skipping this. This is the same question that I've picked up from the practice questions that are given in the study material. This is question number 5 of practice questions. There is nothing new in this, hence I'm skipping this, correct? Because similar thing we have used. Now let's come to the next question. The next question is something different. It says that A&R Limited is a large cap multinational company listed in BSE in India with a face value of rupees 100 per share. They have a face value and their stock is listed. That means they are a listed company. The company is expected to grow at the rate of 15% per annum for the next 4 years, and then they will grow at a 5% indefinitely. So students, please understand this information very carefully. Today we are sitting at 0. Then this is 1, this is 2, 3, 4, and then 5. So from 0 to 1, they will grow at the rate of 15%. Similarly, here they will grow 15, 15, and then 15. For the 4 years to come, they will grow at 15%, and then they will keep on growing at 5% indefinitely. 5% indefinitely. That means their terminal value has to be calculated. Now, please apply the same concepts, the same learning that you would have done in your capital budgeting, because in capital budgeting also, at some point of time, you have to calculate a terminal value. Terminal value is what? Whenever your business will keep on generating constant cash flows with a constant growth, you can easily calculate a terminal value. Okay, please don't get disheartened. Again, I'm saying, Pooja. Yes. Okay. Please do practice more and more. Please devote more time to the studies. Okay. That's the way only to conquer. Okay. By losing hope and by not doing anything, we are going nowhere, right? Ultimately, we have been given a task in hand, and we have to conquer that. Simple. Do with that motive and do with that, objectivity in your mind. Okay, now coming back. So I hope this case is clear, right? It is very much relevant to what we have studied in our capital budgeting. The shareholder expects 20% return on their share investment. Company paid 120 as a dividend per share for 2021. They are saying that they have already paid a dividend of 2021. The shares of the company are traded at an average price of 3122, and find out the intrinsic value of per share and state whether the shares are overpriced or underpriced. Simple. So they are saying that as of now, they have paid how much as dividend? 120. So can we calculate what is the dividend going to be in all these years? Yes. Can we also calculate that what is their present value? Yes. So this is a question on dividend discount model. Dividend discount model with unequal growths, which was the third case that we discussed in our dividend discount model. Second case was Gordon's model only. Third case was this one. Now simple, the price will be, see what is the amount? 120 into 1.15. This is year 1. 1 plus 20%. 20% is the discount rate, right? That is the cost of equity. Then in this, we will add 120 into 1.15 into 1.15. This is for year 2. This is year 1. This is year 2. I'm not writing it horizontally. I'm writing it vertically so that it is clear. Okay. This should be raised to the power 2 because this is for year 2. Okay, now in this we will add 120 into 1.15 into 1.15 into 1.15. This is for year 3. Divided by 1 plus 20% raised to the power 3. Then again, for year 4, the growth is 1.15 only. 1 plus 20% raised to the power 4. Clear? Now, at the end of 5th year, so till now we have covered 4 years till end, right? Now, at the end of 5th year, we will have to calculate a terminal value into 1.15 raised to the power 4 into. So what is going to be the dividend at the end of 5th year? So at the end of 4th year is this much, and at the end of 5th year it is going to be this much. 1.05 we have to multiply. Whole divided by 1 plus 20% raised to the power 5. And one more thing what we have to do, since this is going to be perpetual, so going by the logic of terminal value, we have to take KE minus growth rate. Growth rate is 5%. Right? I hope this is clear. So see, what is the net effect of this? Okay, let me write to make it more understandable manner. I'm shifting this here. 20% minus 5%. 1 plus 20% raised to the power 5. So see, this is what it is doing. It is doing the present value of that. And this is calculating your terminal value. This is terminal value at 5th year end. And this is making TV at 0th year. Correct? I hope this understanding is clear. Perfect. So Mansha, your answers I hope will be correct. D1, yes. You have kept the D1s perfectly. It is fine. Yes. Mansha, your answers are right. So now, if we solve entire these things, so it comes as 1022.42 rupees. See, the only new thing in this entire question was what? The terminal value. So for the next revision, for the third revision, you please mark this question because this is something very different. For the Gordon's model, Walter's model, I think we have solved more than 10 questions now. And similarly for theory also, I think we have solved more than 5 questions now. Some of them are repetitive in nature and some of them have a very brilliant point. So my request to you is to use that you keep on noting those new point, or let's say you keep on marking those questions where you feel are having something new to learn for the next revision. Okay. Now, coming to the 20th question. I hope this is okay. Let's move to the next question. Fine. So I think this is again a very, very, very different question. Okay. You should understand this very deeply. Okay. See, it says that in May 2020, shares of RT Limited was sold for 1460 per share. So the price is equal to 1460 per share. This is given in the question. A long-term earnings growth rate of 7.5% is anticipated. Earnings growth rate of 7.5% is anticipated. Okay. RT Limited is expected to pay a dividend of 20 per share. They're expecting to pay a dividend of rupees 20 per share. First of all, calculate the rate of return an investor can expect. What is the expected rate of return? They're asking about KE. They're asking about KE, right? To earn, assuming that the dividends are expected to grow along with the earnings of 7.5% per year in perpetuity. So they are saying that your dividends will grow in perpetuity, and hence you tell us what is your cost of equity. Okay, students, now if you see the dividend growth formula, this is given by Gordon's. What did he said? P0 is equal to D0, 1 plus growth divided by KE minus growth. Correct, students? That is what he told. Now, instead of D0, 1 plus growth, can I say that it is D1? Yes, we can say that. Because D0, we always said that whatever dividend we have paid last, in that we will take a growth rate and we will arrive at the dividend to be paid in future. Now, if we are already given that what is the dividend we are going to pay in future, we can ignore all this jugglery and we can just simply say D1. Correct? So P0 is equal to D1 divided by cost of equity minus growth. This is fine. Yes, this is fine. There is no issue. Actually, if you see, this is nothing but your terminal value formula only that you would have used. Correct? Because this will calculate your terminal value at your 0th time, at the 0th day. So using this, can we substitute everything in this and calculate the KE? Because we have everything else. We have price. What is the current price? 1460 per share. What is the dividend we are going to pay? We are going to pay a dividend of 20 rupees. KE we have to calculate. What is the growth rate? Growth rate is 7.5%. Okay, so KE minus 7.5% is equal to 20 divided by 1460. Okay, if we calculate this, okay, wait, I think there is some conflicting thing also which can be assumed here. See, now, okay, there are two views possible here according to me. Okay, one is, since the question is saying that it is expected to pay a dividend of 20 per share, so we can directly assume it is a D1. Okay, or else we can also say, I mean, it is a D0. Expected to pay means they are expecting to pay now. Okay, both the interpretations are possible, and hence we can say that, okay, 20 into 1 plus 7.5% will be our D1. So both the assumptions are possible. Okay, whichever way you want, we can assume that. Yes, Kiral, you're right. P ratio sum is also new. Yes, Mancha, you're right. Fourth year terminal value was also right. Okay. So see, it is again a choice here, because see, question has said that it is expected to pay. We can also assume that it is going to pay after a year end, hence it is D1, or we can also say that it is expected to pay now, which is D0. In case we assume that, then we will multiply it with 1.75%. Okay. So what we should expect? Okay. In our study material, the stand is taken that this is D0. Okay. So I'm also taking the same stand here. I'm making this change, assuming that this is 7.5%, 20, and we are taking it as D1. Okay. So our KE is equal to 8.97%. Fine. So Hitesh, your answer is correct. That's right. Now, second part is very interesting here. Okay, first part is understood. Okay, I'm again saying, if you assume that it is a current it is a D1 rate only, it should be always be okay. Okay, because the question has said it in that manner. The second part, it is saying that it is expected that RT Limited will earn about 10% on retained earnings, that is R, and shall retain 60% of the earnings. In this case, state whether there would be any change in the growth rate and cost of equity. So they have, in the second part, they have given you two more things. They are saying that in case they earn R of 10% and they retain how much? 60% of the earnings. Then you suggest whether G will change and hence cost of equity will also change. Yes, definitely it will change. See, first of all, with the new rate, can we say that growth is equal to B into R? So growth is equal to 10% into 60%. So it becomes 6%. So the revised growth is 6%. Original growth was how much? 7.5%. Now, if original growth was 7.5%, okay, and R is equal to 10%, the retention ratio comes out to 7.5% divided by 10%, which is 75%. Correct? So we are trying to calculate that in our previous case, what is our retention ratio and hence what was our payout? Our payout was 25%. Correct? This is correct. Now, what we have done is here is retention ratio, which is B is equal to G by R. Since G is equal to B into R, so we have applied this formula here. So Rahul is saying that what is the difference between both Gordon formulas? There is no difference, Rahul. One is actually taking the earnings into the numerator and second one is taking the dividend in numerator. However, the formula which is taking earnings in numerator, that also multiplies by 1 minus B, which effectively makes it as dividend only. Okay. Now, I hope till now it is clear. Now, if our payout ratio is 25%, what is our actual dividend? Dividend per share, we are saying it is 20 rupees. So can we say that what is our total earnings? Total earnings will be 20 divided by 25%, which will come out as 80 rupees. So this is what we have calculated from our previous steps. From our previous part that was given, that we are expecting a earning of 80 rupees. On that, we will pay a dividend per share of 20 rupees. Okay. And hence our new cost of equity, for that we will need our new dividend, correct? Because our dividend payout ratio has changed. So if the retention is 60, so the dividend payout ratio will be 40%, correct? On our earnings of 80 rupees. So it will be 32 rupees. So the moment it is 32 rupees, I am just applying the same formula, 32 divided by 1460 multiplied by 100 plus 6% is our revised growth rate. So the cost of equity as per this comes as 8.19%. Hitesh, your answer is correct. 80 is the EPS and dividend in the revised scenario will be 32 rupees and hence your cost of equity will revise to 8.19. percentage. Vansha, your answer is correct. 8.19 percentage, 0.0819. Okay, so why there is a need to calculate the earnings as per the first case here is because we have changed the retention ratio. The moment you change the retention ratio, your growth will also revise and your dividend will also revise. Because you can't say that earlier if you were paying a dividend of 80 rupees, sorry, 20 rupees, and your dividend percentage was 25%, then you can't say that, for 40% it will be how much. So you, because there is a change in growth rate also, so you have to recompute your overall earnings because your earnings will not change. Your earnings will remain same, and basis those earnings, you will have to recalculate the percentage here. So it's 7:20 students. We will break for 10 minutes. We will again reconvene at 7:30. Thank you. Welcome back. So we have just now discussed on the question number 20th, and there is a query from Mancha. She's saying that, sir, there is some correction in the study material. Question number 6, answer given in study material is wrong. Corrigendum uploaded. Okay. So what I also feel is in this question number 6, in study material, by mistake, it was mentioned as 1.15 here. Here. It was mentioned as 1.15. Okay. We have correctly mentioned here, which is 1.05. The answer is right. The answer is right. However, just I think it would be just an error, typo error. Instead of 1.05, it was mentioned as 1.15. Okay. But our answer is correct already. So there is no need to worry here. Okay, Mancha? Now, let me come to our last question on dividend. Then we will quickly take a revision and I will take up the queries of Hiral. Yeah, I will take the queries of Hiral and then we will quickly take the revision on risk analysis. Okay. Question number 20 first. This is the last question in the practice questions of the study material. Okay. So Akash Limited has 10 lakhs equity share outstanding at the start of accounting year 2021. The existing market price is rupees 150. Expected dividend is rupees 8 per share. The rate of capitalization, which is KE, actually in our language, appropriate to the risk class to which company belongs, is 10%. Calculate the market price per share when expected dividends are declared, not declared based on approach. Very simple. So, solution, calculation of market price per share when dividends are declared. So in this particular case, P1 is equal to 150 is the existing market price, 1 plus 10% minus the dividends are going to be declared as 8 rupees. So hence the P1 comes as 157 rupees. B part, dividends are not declared. P1 is equal to 150 is the P0 price, 1 plus 10% cost of equity minus 0. So P1 comes as 165 rupees. Then the first part was very easy and very simple. Okay, Hiral is saying in the new study material it is 1.05 only, so which is fine, Hiral. I think they would have issued corrigendum to the previous study material because in the previous study material it was 1.15. Okay, Karthik, you are right. 1.165 is the right answer. Okay, next one. The next part it says that calculate the number of shares to be issued by the company at the end of the accounting year on the assumption that net income for the year is 3 crores. Investment budget is 6 crore. Again, there are two cases they are saying when the dividends are declared and dividends are not declared. So simple. Number of, what is they are saying? Shares to be issued. We will take case A here and B here. So A is declaration, no declaration, right? So in case they are doing anything, there is an investment of how much? 600. So this is in rupees lakhs. We can put this is also 600 lakhs, which is 6 crores. 6 crore and 6 crores. Then their income in both the cases will be 300 crores. Sorry, 300 lakhs, 300 lakhs, which is 3 crore. Dividends is how much? 80 lakhs and nil. Correct? So 80 lakhs we have computed how? Number of shares multiplied by dividend. Dividend is 8 per share and number of shares are 10 lakhs, right? So 80 lakhs. Total funds requirement. Net funds requirement is how much? 380 and 300 divided by price per share. So price in case we are declaring is how much? 157. And this one is 165. So number of shares comes as 2.42 lakhs and 1.82 lakhs. Simple. After dividing. Perfect. Karthik, your answer is right. No, so 220 by 157, Karthik, why have you done that? Just check that piece only alone. So this is okay. 380 by 157 is okay, but this should be 300 by 165. Okay. Now, last part. Last part, they're asking what? Proof that the market value of the shares at the end of the accounting year. This is the change in question, students. See how beautifully it was drafted. And we were going to commit the same mistake by calculating the value of the firm at the beginning of the year, because always till now every question of approach we have calculated the present market value, right? The present value of the firm. Now please, again I'm saying that these are the only minute things which you have to deal with. It is saying that prove that the market value of the shares at the end of the accounting year will remain unchanged irrespective of whether dividends are paid or dividends are not declared. Now, I think a lot of your queries will get resolved, because today also there was a query whether T1 value is equal to T0 value in case of approach. I told no. T1 and T0 are never equal, but T0 in case dividend are paid or not paid is equal, and T1 in case dividend are paid or not paid should be equal. Correct. So calculation of value of firm at the end of accounting year. So this is A and this is B. Declared, not declared. Existing shares were how much? 10 lakhs. This is in lakhs. Delta N, which is new shares, 2.42, 1.82. So the total shares are how much? 12.42 and 11.82. Market price per share. This was how much? 157. This was 165. Value at the end. So we'll just multiply this. 1950, 1950, approx and approx. So students, how beautifully this question has changed the requirement, and we would have very easily gone into the trap. Hitesh, number of new shares are your answer is correct. Hitesh, again your answer is correct. Mansha, yes, you're right. Both are 1950, both are 1950. Perfect. Okay. Now, if you see here, students, see value of the firm at 0th day is how much? This much. Value of the firm at end of the period is how much? This much. Correct. But you cannot say that this is equal, because first of all, we know that there are 1 plus KE is what we have to take a present value of. And then there are other factors as well, which is investment and income. Correct? So minus I plus earnings. Okay, students? With this, the questions are over. Yes, Mancha, your answer is correct. Yes, I think Mancha has calculated both the values, 1500 as well as 1949.9. Perfect. Now, let us quickly spend some time on dividends only, then we will go to the risk analysis. Okay. I'm just doing a quick revision with all of you. Okay. And in case if there is any doubt left on dividend and risk analysis, please do let me know during that. So students, while reading the dividend decision, we first of all understood the importance of dividend decision. And we understood that there are three types of decision making apart from the normal operating decision making. One is financing decisions, second is investing decisions, and third one is first is financing, second is investing, and third one is dividend decision. So this is a topic on dividend decisions, which we bifurcated further, that always there is a dilemma with the company how much to pay and how much to retain, and whether they can retain or whether they can pay. Now, dividend payment we discussed can happen through a cash outflow, and in a way it can happen through bonus share. Although bonus share does not increase the total value that a shareholder holds, but it gives them more flexibility and freedom to sell a part of their shares and hence realize something in cash. Okay. Then we discussed that if there is an abnormal item of gain, then how company should do. So that is also a part of the dividend decision making. Then we have studied that what are the significance of a dividend policy. Definitely there were two significance. One is that it will help you in a long-term financing decision. If you have already identified an investment opportunity where your return on equity is actually good, then you can think of investing your surplus cash that you have rather than paying it as a dividend. Plus, we also understood the wealth maximization decision. It will help in such a way that, first of all, if R is greater than KE, then we will keep the money and it will multiply at a higher rate compared to if it would have been paid to the shareholder. Second thing, what we discussed here is that immediate dividend will have a higher impact on MPS because of uncertainties in future. Then we discussed that what is the retained earnings and growth relationship. So we said that the growth comes if you reinvest your retained earnings, right? At what rate? The rate will be your actual rate of return, which is your R. And growth is what? Something incremental to your current amount. And current amount is your base amount. We said that if we have this much of earnings, so there will be two parts. One is the retention part and second one is the dividend part. Whatever you retain on that part, you will generate a ROI and hence there is an incremental income, which is in the form of growth. Correct? So this was the formula of growth. Then we came on to discuss about the theories of dividend, which definitely are restrictive, which operate in a certain framework. So irrelevance theory came from Modi, Gilani and Miller, and relevance theory came from Walter's model and Gordon's model. Now, irrelevance theory said that whatever dividend decision you adopt, the value of firm will not be impacted. The important point is value of the firm. Again, students, I'm highlighting one more thing. We are not saying that MPS will not get impacted. We are not saying that because MPS gets impacted. If you pay dividend, your MPS will be lower. That is cum dividend and ex dividend theory that we discussed. If your dividend is zero, then again your MPS will be higher, right? So MPS will get impacted, but your value of the firm, which is the overall value, the capitalization value, it will not get impacted. That is the irrelevance theory. And here we discussed about the cum price and the X price before dividend, after dividend. And we also had discussed some 2-3 steps. Okay. However, the main step is this one only. I mean, the main steps to remember are these ones only. Yeah, this is the main formula, which helps you in determining the future price. The P1 is equal to P0, 1 plus KE minus D1. In case dividends are paid, then we will substitute this value with D1. In case dividends are not paid, we will substitute this value with 0. Similarly, we also studied that what is the value of the firm. The value of the firm is given as this. N into P0, or value of the firm is, we take the future value, this one, adjust it for the investment and earnings, and take a present valuation of the same. Okay, perfect. So this was what was given under irrelevance theory, and we discussed some of the questions basis that. So ultimately, see, irrelevance theory, what we have to do is, it is a very scientific approach. There are 4 steps. One is you calculate the future price. Second, you calculate your funds requirement. Third one, you calculate basis your funds requirement divided your future price, what are the number of new equity shares. And lastly, you calculate your value of firm. Simple. 4 designated steps. You will get your full marks. Coming on to your Walters model. Walters model said that you have to base your price on dividend and your retained earnings. Because on retained earnings, you will be generating R and you will discount it using KE. And finally, you will take a present value of KE. And here we studied about the relationship on R and KE. There are 3 cases. One is growth case, constant case, and declining case. In case of a growing case, your dividend payout should be 0, and otherwise it should be vice versa. Okay. Then we studied about the Gordon's model. Gordon's. Yeah, this was our Gordon's model. Gordon's model said that you take your earnings and multiply it with the dividend payout ratio. In a way, this numerator is nothing but your dividend, right? That is expected to be paid at year end, and that you multiply and that you divide by your cost of equity minus growth rate, assuming that perpetually you will keep on getting this much of dividend. Okay. Then we go on and studied about bird in hand theory, which is the Gordon's model, the revised Gordon's model. It also said the same thing. D1 divided by KE minus G. Simple. Then we studied about dividend discount model. One is zero growth. Zero growth, D by KE, you will get the price. Constant growth, you can apply the Gordon's model. Okay. Then variable growth, as written above, you will have to take a present value for the different years. So this was our dividend growth rate. Then there were some traditional model, which is Graham and Dodd model, which said that price will be multiplier of dividend plus earnings, but earnings we will take it divided by 3 because we feel that earnings should be 1/3 of what dividend is. 1/3 weight should be given what weight is given to dividend. And overall, there should be some intuitive number on the multiplier, and hence we will be able to arrive at a price. Then we also studied about Linter's model. Linter's model said that your dividend in future is dependent upon what is your average target payout ratio. Because as a group, you would have some aspiration that how much your target payout ratio should be. And ultimately, your dividend should be a deviation from your existing dividend that should be adjusted to your existing dividend. So if you see this is your deviation from the existing dividend. EPS into target ratio is your deviation from the existing dividend, and adjustment factor, if it's multiplied, it will give, and you add it to your existing dividend, it will give you a dividend for the next year. Okay. Then we also studied about the stock splits. We said that what is a stock split? Stock split is generally splitting your one equity share into many equity shares, and any value is not impacted here. It will just improve your liquidity. Now, Mansha has given very good expert from a newspaper. So that excerpts from the newspaper, it says that bonus shares improve liquidity as the price of a company share fall. Depending on the issuance ratio, lower scrip price tends to increase retail participation. That is a very, very, very important point. See what happens if you reduce. So in a way, stock split and bonus share also have the same impact, because your value remains same, the total value remains same, but now the divisible number increases, and hence your price per share comes down. The moment your price per share comes down, your liquidity increases, and where a shareholder who was investing, let's say 10,000 rupees, and he would not be able to, completely wipe off his investment because his one share was 10,000. Now he can, once his 10,000 rupees is converted into 50 shares of 200 each, he can sell some amount of those 50 shares to earn some capitalization, or let's say to earn some hard cash, to take a benefit and to improve the liquidity. So that is correct, Mancha. What you're saying is correct. Okay. Now, next one was this only. Then this was a, something irrelevant theory from our end. Okay. So that was an irrelevant theory from M&M. This is an irrelevant theory from our end. But please don't focus on IRR. Again, focus on R and KE. Okay. Then we gone and
Recording in progress.
sorry, technique, Ashok ji, is it? Okay, okay, thank you. So, as I said that there were three terms that we discussed. One is certainty, risk, and uncertainty. So all these three terms have different meanings. However, we evaluated risk more in detail. We said that in risk there are different scenarios, and with some kind of probability we can estimate them. Hence, there is a term called estimated cash flows versus expected cash flows. Right, Hiral? I will take your query, Hiral. Question 3 of module, page number 8.33. I will take that. Okay. Now, these are those estimated cash flows. Using estimated, we will compute our expected. Expected is mean. And estimated are different possible scenarios. Okay. So using that, we calculated mean, and we said that using that, we can also calculate risk. Risk is standard deviation or variance. That will also help us in evaluating that what is the upper and lower range. Then we said that, okay, in statistical terms, average is mean and risk is variance or SD, whichever way you can say. Then we came on to techniques. So the first technique was probability. probability, we said that it is the chances of an event occurring. It can be between 0 to 100% or 0 to 1. And it is always on a forward looking data. Using this, we arrived to calculate expected net cash flows and expected net present value. Okay. Then we attempted some questions. Second topic under this techniques came on the variance, which is the deviation of estimated value from the expected value. As the name is suggesting, estimated means all the possible values. We will reduce it from the averages, okay, which is the expected value, and arrive at the variance. Simple. Now we discussed that in case there are two projects, project A and project B, where we are given SD and mean, then how can we determine that which one is better? We will take help of coefficient of variation. We will do SD divided by mean. For 1 unit of mean, how much risk are we going to take? Then we attempted some of the questions. Yes. Now, okay, before that, Bharadwaj is saying that please explain this concept of stock splits again. So stock splits, as we discussed, were nothing but splitting. Let's say there is a 10,000 rupees worth of stock. There's a 10,000 rupees worth of stock. One share is that. Now, ultimately, what is happening if I am an investor? Okay, I am not able to sell it because I only want to sell, let's say, 6,000 worth of stock from this. I cannot do that because one share is 10,000 rupees. So what company decides is company will split this into, let's say, 5 shares. So now ultimately every share has a value of 2,000 rupees. Still the total value that this investor holds is 10,000 only. So there is no change in the total valuation. The total value is same. However, now this investor have a improved liquidity. Now what this investor will do, he will sell 3 shares and retain 2 shares. By selling 3 shares, he will get a cash of 6,000, and by retaining, he will be ultimately be meeting out his objective. So that is what the objective is. It has improved the liquidity in the hands of shareholders. Yes, Hiral, you're right. Okay, so Hiral and Mansha, this RADR and CAPM, I will take once we discuss and revise this. Okay. Now, Mansha, there was a question, Graham model takes into account DPS or it is expected DPS. I already explained that it will be any DPS whichever is given in the question. Because it is not clear, it is D1, D0, what? So whatever is given as, I mean, whatever we are taking as D, it should be taken as for the same period. Okay. Whatever is given in the question is what my answer is. Yeah. Now I'm coming to RADR. Okay. RADR is interest. I explained that why we pay interest. Interest is paid for 2 reasons. One is the time value of money and second is risk. Higher the risk, higher the interest. Time value of money is constant. Whatever you are getting on a risk-free rate of return, you will be getting it under a time value of money. Now, discount rate is a combination of risk-free rate and risk premium. We said that RADR is risk-adjusted discount rate. If you feel that the project that you are undertaking is very risky, you increase your discount rate so that while you do your present value, it becomes lesser and the project becomes unviable. Okay, that is what RADR is. So RADR means that evaluating a project at a higher rate of risk, a higher rate of discount. So that will mean that you are taking into account the risk factor. On the other hand, certainty equivalent method said that instead of adjusting your discount rate, you adjust your cash flows, because your cash flows are risky and guaranteed. So guaranteed means where there is no risk. At least 1,50,000 you will get. This is minimum guaranteed. This is certain. And here 2 lakh is the risky proposition. That means higher cash flows, higher risk, right? So we said that there is a term called coefficient of CE, which is 150 by 2 lakh, which can help you to convert the risky cash flows into the guaranteed cash flows. Okay, now then what we did is we compared both the approaches. Now this was one of the query from Hiral, that what is the difference between RADR and CAPM? Sorry, RADR and certainty equivalent approach. So RADR, it increases the discount rate. However, CE, it reduces the cash flows. Both of them have a same impact of lowering down the NPVs. We cannot use RADR and CE together. That means we cannot use the higher discounting rate and lower cash flows together, because then we are accounting for risk twice. Here, either we have to use RADR or we have to use certainty equivalent approach. And this is what I said. If cash flows you are taking risky, then you take discount rate as RADR. If cash flows you are taking guaranteed, then discount rate will be risk-free cash flow, risk-free rate. Now I'm taking this query on page number 8.33. Just opening my study material. So risk analysis and capital budgeting, and I'm going to page number 8.33. Third page number. So what is the question from Hiral? Question number 3, module page 8.33. Question number 3. Oh, okay. So third, and you are asking about the second part, right, Hiral? So Hiral's question is, we attempted that question in our class as well. Yes, this one I think, right? This one second is what your query is, Hiral. Yes. So third second is this one only, Hiral. Third second. Yes. See now, this was a question on certainty equivalent first of all. So it had given us the certainty equivalent, and second part it asked us, if the risk adjusted discount rate method is used, identify which project would be appraised with a higher rate. Now you see, Hiral, that wherever we have a higher certainty equivalent method, that means that project is less risky, because guaranteed cash flows are very equal to a risky cash flows. See, what do we mean if we say that? Can I write here? There. Yeah, okay. Let me write here. So we say that if CE is higher, it means that project is less risky. And why are we saying that? Because if CE is higher, that means the guaranteed cash flows are almost equal to risky cash flows. That means there is no risk. There is very minimum risk in their cash flows. Okay. I hope you got my answer. Then Mancha also had a question number 6, page number 8.34. Here we have to calculate RADR using CAPM. Okay. That is fine, Mancha. That you can do. No. See, CAPM, since we have not covered in my session, what is CAPM? CAPM is capitalized pricing model. It says that you have to take a risk-free rate plus you have to take a risk premium. That risk premium is dependent on beta, right? So that can be done. That is okay, Mancha. I am not too sure whether all of you have studied CAPM earlier, hence I have not picked up this separately. But once you do CAPM, you will find this very easy. Okay. Now let me go up and understand. So Hiral, I think your query is answered. Mancha, your query is answered. Um, Let me see. There was one more query which I kept on hold. Mancha, there is some correction in study mode. This is done. Give me a second. I'm just seeing whatever was the previous query unanswered, if there is anything. Hmm. Page number. This is all done. Now Hiral had also asked illustration 10, page number 8.25, and explain the difference between CE method and risk adjusted method. I hope now it is clear, Hiral. Let me go to page number 8.25 also and see it once. If there is something else need to be said. 8.25. Hiral, just check it is not page number 8.25. Illustration 10 is on something else. Acha, you were asking something else on this. Okay, let me take up this illustration then. Okay, there were two questions, Hiral, that you asked. One is illustration 10, page number 8.25. From the following details relating to project and sensitivity of project initial. Okay. Okay, got it. So this one also we carried in our session. Yeah. Question number 8, Hiral. This also we solved in our session. Okay, I'll come to sensitivity, then I will cover this. But I hope RADR and this one is clear. Okay. Now let's go to other techniques. Other techniques were sensitivity analysis. In this, we said that capital budgeting is a model. Okay, it's a model, calculation model. In that calculation model, there are certain sets of inputs and there are certain sets of output. If these are certain sets of inputs, cash inflow, cash outflow, discount rate, and time, which you input in this capital budgeting and you will get a NPV. Now, all these inputs, the output is dependent on all these inputs. The way you change your input will have an impact on your NPV. That is called as sensitivity analysis. So change of input would result in change of outputs. That will give you sensitivity of what? We said that wherever change of input is maximum, that means there the change of the input is more sensitive. Okay, but on a vice versa case where change of input is maximum and your output is very slightly or very little moving, that means that is not very much sensitive. Because what is more sensitive? A very small change in input will bring a very big change in output. Simple. Just remember this. Then we studied about this question number 8, which is illustration 10 on page number 8.25. Hiral, this is what your question was. So this question said that analyze the sensitivity in relation to all these. Now, it also said that these are adversely affected. Now, I just wanted to understand the initial project cost, if it is adversely affected, that means it has to be increased by 10%. Annual cash flow, if you want to give impact of adverse effect, then it has to be reduced by 45,000. So reduced by 10%. And cost of capital, if you have to give a adverse impact, then it has to be increased by 10%. So 10% on 10% is 11%. So that is what we discussed in our class. Okay. And in the session as well. Yes, Hiral, you're right. In risk adjusted method, higher rate is used and higher rate will be used in that project which will be highly risky. So See, we are not saying that we will use the higher rate along with the along with the certainty equivalent cash flows. We are not saying that. We are just simply saying in the previous case, we will use higher risk adjusted discount rate. Sorry, where is that question? Okay, wherever it was. So we will use the higher discount rate to evaluate project M. Okay, because M is more risky compared to N. That means project M discount rate should be higher. Simple. Banredi is saying I say issued corrigendum study for correcting the mistakes in print edition. Okay. Mancha is asking, sir, I've seen the traditional capital budgeting technique where cash flows are certain. We also use expected cash inflows. This term should not be used because expected means cash inflows are probably. Okay, now again, Mancha, I'm saying that this expected, you have to again see it from the context. Okay, now in that, definitely expected would mean, see here in the risk analysis in capital budgeting, the context is that, see, generally use expected with probabilities. Okay, wherever you have different probabilities, different scenarios, you want to calculate the average, you simply say that it is a best possible outcome, which is the expected outcome. Correct. So that is why this term is used here. Okay. So this was the sensitivity analysis. Then finally we came on to the scenario analysis. So scenario analysis, we said that, see, in sensitivity analysis, we were changing one factor at a time. Scenario analysis, what we did is we changed all the factors and we made 3-4 scenarios, and then we asked to calculate the NPVs. So scenario 1 can be, let's say, cash inflow 1 lakh, cash outflow 50,000, and discount rate of 10%. Scenario 2 will be 122 lakh, 8%. So we will calculate one basis this and second basis this. Simple. Sorry. Okay, then we solved some of the questions, and yes, we wrapped up the risk analysis part as well. Now, students, if there is any other query, please do let me know from these two topics. I would be very happy to answer them again. If you have any doubt left, please don't hesitate to ask it again. If that query has already been asked, please ask it again. But please don't leave with any doubt from this session, is what my request is to all of you. I think mostly we have covered the topics on risk analysis and capital budgeting, as well as the dividend decisions. Okay, both of them have good amount of relevance in practically whatever we do, right? So don't feel that these are, very theoretical topics and, nothing is helpful in the practical purpose. So now there is one query from Banredi on any tips how to present well in exam. Okay. See, first of all, we have to understand that there is one thing called as main answer, and there are some working notes. Correct? Please don't feel shy in putting as many long as working notes, because those working notes are also considered as part of your main answer. Okay, so don't feel that, if I'm putting working notes, what it would be. And always show step by step whatever you are doing. Please do start with the formula, right? Whatever is the formula, please do put that, because it will help you only to make sure that you are not doing any mistake. Okay, I don't know anything about the examination, marking scheme here. That I don't know, but I'm telling you so that you don't make some mistakes. If you directly try to put certain things in your formula, directly input, if you have formula in your hand, because that examination pressure is very huge. So if you write your formula correctly, then you just try to put it in your formulas and arrive at the number. Please be as detailed as possible, and it's always good to leave something in comment if it is asked in the question. Please write some sort of a logic, or let's say some sort of a theoretical understanding that you have. Now, for example, in our just now the first part of the session, a lot of places they have asked whether what is the optimum dividend policy. So try to frame that sentence in such a manner that since R is greater than KE, that is 12% is greater than 10%, and hence it would be most beneficial for the company to invest the amount back into the business to earn a 12% return over an expected return from the investor of 10%. Hence, it is advisable to keep the dividend payout as minimum as possible, that is 0% payout. Okay, something of that sort. So that will, so these things really help, Bandreddy, is what I can say. Hiral is asking the scenario based questions solved from page number 8.34. Thank you, Bharadwaj. Mancha is asking, okay, let me take Hiral's query. Hiral is saying page number 8.34. 8.34. Let us go to 8.34. Are you talking about sixth question, Hiral, right? Solved scenario based question solved from page number 8.34. If it is question number 6, then it is very easy question. So basically, see, in the question number 6, it is given, you are given 3 projects. P1, P2, P3, cost is given, inflows are given, and you are also given the risk index. Acha, nahi. So this is for RADR. Wait, sorry. Can you please specify which question are you asking, Hiral? Because 8.34 have many questions and we will waste our time in finding which is the this 3. Maybe you're asking about question number 5 then. HG Limited is considering a project Z with initial outlay of 750 and life of 5 years. And they have given lower estimate base. Okay, now here the catch in this question. See, they in question number 5, page 8.34, they have given 3 things. One is the lower estimates. Now see how examiner have played, really well here. And they're trying to test you upper estimates. So they have given 3 estimates. One is lower estimate, one is base estimate, one is upper estimate. So lower estimate, they have given lowest possible everything. Even the fixed cost, they have given this as 50,000 here. And even the cash inflows also, they have given minimum here. So minimum, and here they have given maximum, and here they have given base. Okay. Now what the question is determined in such a manner that it says that 3 scenarios: worst case, best case, and base case. So they are asking about 3 scenarios. Now, please don't make a mistake of assuming that this lower estimate is as good as worst. No. The cash inflows of lower will be the worst, but the cash outflows of lower should be taken, in the best case. You're getting my point? Because these are the lower estimates. So the lower estimates of fixed cost should be taken in your best case scenario, because best case scenario will be lowest fixed cost, highest cash inflows, lowest discount rate. Okay. I hope this catch in the question is clear. Now, Hiral, once you are able to understand it, then this is just a simple question on capital budgeting. So the only thing is, I am putting it in a fair manner here. Worst, base, best. So cash inflow should have lower estimates here. And here they should have higher estimates. Base is as good as base. Cash outflows, they should have, for worst case, they should have higher estimates, correct? Whatever is the highest estimate, you should take it. And for best case, you should take the lower estimates. And here you should take base. I hope this is clear. Okay, Hiral, question number 5. Yes, I have answered. Okay, Pooja is saying handwritten notes. I need to check, Pooja, whether we're allowed to do so. We will check. If it is possible, then we will definitely upload it. Okay. I haven't understood the capital budgeting. Okay, so capital budgeting again, Pooja, I would suggest that it's a very interesting and very practical topic. So you can go through that. First try to understand what is the basic model, because see, risk analysis is cherry on the cake, right? You have to understand how the cake is made first of all. So if you are able to understand the basics of capital budgeting model, then some of the complexities they have introduced in the capital budgeting model, and then lastly the risk analysis, that would be the right sequence to study. Okay, Hiral, thank you for that. And Siddharth is saying, okay, thanks a lot, Siddharth. I hope this time actually I am not very confident that I am been able to deliver it properly or not, right? But somehow you guys are clear, so then it is fine. Mancha is saying positive change in variable on the outcome can also be considered by sensitivity and scenario. Yes. See, change can be, what is change? Change can be positive or negative both. It can be positive also and it can be negative also. We are talking about the intensity of change in sensitivity analysis, right? Intensity of change. How big that changes, not in what direction that changes. Okay. Okay, Mancha. Perfect. So I think all of your queries are done mostly. Okay, students. So these are the closing remarks from my end. If anything is left, please again, I'm still saying that do reach out to the BOS, and all our faculties are there to help you, support you. Please again, I am requesting you, all of you, to do revise well, because whatever you are taught here, you just understand it at first, then you have to retain it. From that objective, you have to do revise well and prepare well for the examination. Please do take care of yourself and our parents, and yeah, I hope to see all of you in the profession sometime later. Okay, till then, see you. Please do read well. Thank you. Thanks a lot, everyone. Technical team session over.